Hey guys, welcome back to the channel. So I wanted to go over some strategies to handle market volatility. These are both practical strategies and sort of psychological tactics to avoid making any sort of impulsive decisions with your portfolio when the market starts to turn. So year to date, the S&P 500 is down about 2.43%. And this isn't like a huge downturn, but considering that the last 2 years have been over 20% gains, you can see how people might start to get a little skittish when it comes to investing in equities. Of course, people say sometimes that equities now are overvalued. It's hard to say really without sort of seeing what the year looks like. But with such strong returns for the last 2 years, we can expect some market volatility, right? So we're going to see some people who are thinking that equities are overvalued and they're going to sell off. And so you just never know what the year is going to hold. So you want to make sure that that you're investing across asset classes. This might be the year of bonds. Like, who knows whether the S&P 500 is going to be up or how much it's going to be up. It could be relatively flat. We just don't know. And so, yeah, the last 2 years have been great if you were invested in the S&P 500, but we can't tell what 2025 is going to be. So I'm just going to go over a few tactics to sort of avoid making any rash decisions with your portfolio. And staying the course, because that's like the most important thing when it comes to investing, taking a long-term strategy. So again, the very first thing I'm going to talk about is, diversification. This is a sort of like very important thing that that I've talked about a bunch. It's just been shown over years, over decades, that diversification really is just your free lunch. It allows you the opportunity to rebalance your portfolio when there are market changes. It also just spreads out your risk across many different asset classes. And I've gone over different asset classes that you can invest in. The most simplest way to think about sort of the two main asset classes are bonds and then equities. Your bonds are your sort of like safer assets that give you a fixed rate of return but have minimum volatility. And your equities are your stocks that will drive most of your performance, but you can see, downturns in the market. So you have to be willing to withstand the volatility. But, say you have like a very simple asset allocation that's some portion of stocks and some portion of bonds. Well, if equities start to ramp up really high and all of a sudden now your portfolio is even more equity than bonds, you can sell off a little bit of your equities and put it into bonds. That way, when there's a downturn, then you can sell some of your bonds and then move back into equities. What you really want to do is to purchase any sort of asset classes that have been underperforming. And it's shown, rebalancing once a year is sufficient for this. So again, there are all sorts of asset classes you can invest in, but the key here is that you have different asset classes that are going to have different returns at different times. And if you're all invested in one thing, yeah, when it's doing great, you'll look super smart, but when it's not doing great, your portfolio will tank. So it's very important that you just stay diversified. And again, a simple diversification can be bonds and equities. That could be as simple as buying the S&P 500 and then a broad bond fund. And if you want to get a little more sophisticated, you can start to add international equities. You can add real estate. You can add commodities. So there's all sorts of ways to do this. And I've done some diversification videos before, but I would say now more than ever, it's important to diversify your portfolio and really choose your targets and stick to them. So if you decide that you want to have 25% bonds and 75% equities, make sure that you're really sticking to that so that you're not making emotional decisions. So one of my big tips for secondly is just making sure that you're creating sort of an automated investing schedule. And this just means that you're purchasing shares over time, and you're doing this on a regular basis. So, most people have some regular income as long as you're not retired or unemployed at the moment. But if you have money coming in, you should be allocating a portion of that to purchase different asset classes. And what this does is it basically allows you to average into the market, right? So as you have new money coming in, you can dollar cost average. So this just means that you're purchasing a certain number of shares at whatever price it's at that time. So the market is gonna move up and down, but if you're purchasing, say, like on a monthly basis, you're gonna buy into the market at different price points, and it'll make sure that you're just continuing to invest. It takes out the emotion of investing, right? Because if you get scared to invest because the market has turned down, or if you even get scared to invest because the market has gone up so much and you think you're getting like not a good deal, you'll just stop investing. And the most important thing to do is just keep your money working. The worst thing you can do is just hoard your money under your mattress, right? Because it's never going to do anything for you there. So yes, so I would just say make sure that you're dollar cost averaging into the market whenever you can, whenever new money comes in, and that you're automating these investments to take out the emotion. And all of your brokerage accounts should have some amount of automation. And this is just something where they allow you to purchase shares of a stock or an ETF or a mutual fund on a regular basis. So let's say you want the first of the month to purchase $500 worth of an S&P 500 ETF. Most brokerage accounts will allow you to do this, or choose a mutual fund that will do the same thing. So that's sort of the second thing, to just maintain a level head during volatile markets. So yeah, it'll purchase it on a regular basis without you having to worry about it. The next thing is just sort of like a mindset. Just remember that investing is a long-term strategy. It's not short-term. So don't see daily market fluctuations as any kind of indication about your portfolio, because over the long haul, equities will go up, you're going to make money. You just have to be willing to stick around long enough for that to happen. So really seeing investing as a long-term, and we're talking 10 plus years, really you want to think about it as like your retirement. You're building wealth. This is for major purchases that you're going to make in the way future. Things like for your retirement or to purchase a home later. It's really important that you not take a short-term perspective. And in this way, sort of like as sort of an addendum or another point, don't look at your portfolio on a daily basis unless you can handle that emotion. So you shouldn't be making any decisions based on short-term volatility or changes in the market, especially if you're not sort of watching the market all the time. And I would say, especially if you're not planning just to buy more, I would say like if you're planning to just buy and buy and buy, it doesn't hurt to just invest when the market goes down, or even when the market goes up. Continuing to invest is important, and you just don't want to get in a situation where you're selling your stocks because you're scared. The next thing I would say is that, sort of along those lines, like sometimes volatility can be your friend, right? So if there is a pullback in the market, it presents an opportunity to buy asset classes that you may have shied away from because you thought they were overvalued, and instead to buy them at a discount. So if you think longer term that equities are going to go up, even in the next 5 years, even the next year, and you see sort of like an asset class go down by a few percentage points, it might be a good opportunity to just buy some of that. So in volatility, there is opportunity too. And to have that mindset of the fact that like it's not always a bad thing to have volatility. Volatility can be market corrections, right? Things that are overvalued becoming more fairly valued. And during those times, you can take advantage of the corrections in valuation. Also, another great thing to think about, and this goes along with your asset allocation, is just to start thinking about defensive assets. Again, these are things like bonds, which you can have a portion of your portfolio dedicated to, gold, cash even, in a high yield savings account. You can pick assets that are slightly safer and have lower volatility, right? So even within the equities market, certain asset classes have much higher volatility, the energy sector, but some have sort of like less volatility, materials, or sort of consumer staples, things that are sort of more recession proof. And those are things to keep in your portfolio to manage volatility. There'll be lower sort of like movement in those assets, but they'll probably grow by less. So, overall, really, there's two components of volatility and managing your portfolio. One are the practical aspects, making sure your asset allocation is diversified, making sure that you're investing in sort of defensive areas that will help your portfolio during these volatile times, making sure you're dollar cost averaging into the market over time. And then there's the psychological stuff. So those are the two main categories. The psychological stuff is like, think about it as a long-term investment, right? You're looking at your portfolio in a very long time horizon. You don't want to be checking your portfolio daily if you're unable to handle sort of like the emotion of the ups and downs. And so thinking about it in those two terms, I think generally helps us withstand this volatility. Look, we're at a time where sort of like we've seen record gains in the last couple of years. We're going to see more volatility this year. The markets are going to react to lots of geopolitical decisions as well. And we know that we're in sort of like a very sort of unpredictable geopolitical climate. So we can just expect that there's going to be volatility. So knowing that ahead of time, we just can gear ourselves up to withstand that. So I hope you found these like little tidbits helpful. Again, just remember, investing is a long-term thing. Don't get scared by volatility. See it as an opportunity, and just try to avoid the news as much as possible, because most people really don't want to be dealing with that emotion on a daily basis.